Hello, I am Jim Schaefer, a California family law forensic accountant. Prior to becoming a family law forensic accountant, I was a senior tax manager for KPMG in Los Angeles and New York City. I earned my master's degree in taxation from Golden Gate. Although I no longer practice in the field of taxation, I understand that knowing when to direct a client to a tax professional is important. In your practice and mine, we deal with the division of the marital estate in almost every case. And, in almost every case, the division of assets pursuant to a divorce is a non-taxable event. The key word is almost. Under current federal tax law, the general rule is these divorce asset divisions are treated as a gift to the recipient. The result is no gain or loss recognition, and basis for gain or loss is unchanged. Let us stop a moment and make sure the word basis is understood. The IRS explains the word basis as generally the cost to you for determining gain or loss. The higher the tax basis, the lesser the gain and the related tax. One exception to the general rule of Internal Revenue Code Section 1041 is that gift treatment does not apply if transferee is a non-resident alien. In that case, gains are recognized by the transferring spouse. I have two suggestions. First, ask about citizenship early on and just prior to distribution. Second, if the answer is your client or their spouse is not a United States citizen, make sure that your client consults with a tax professional who is experienced in international tax issues. Before closing, let us look at the reason for this rule. If the parties are splitting 1,000 shares of Apple stock purchased at $20 per share and a value of $100 with all shares going to the non-resident alien spouse, the $80 gain would never be taxed in the United States. The exception to IRC Section 1041 taxes the inherent or sometimes referred to as unrealized gain to the transfer or spouse at time of division. Thus there are no lost income tax revenues.